Assalamu alaikum friends and welcome to lecture 8 of AFM. This is the first lecture under risk management. Under risk management we are going to have 3 lectures. First one is this is the first one, we are going to discuss more of discussion question than numbers. Okay, we are not going to go into the main derivatives, but I'm going to introduce you to them. That is, the name of the lecture is role of treasury function. And then second lecture, that is lecture 9 and 10, will be on the currency risk management and interest rate risk management. So let's start with this. Here we are going to focus on the Treasury department, introduction to hedging methods, because you need it in your next 2 lectures, and types of the forex risks. The Treasury and the types of the forex risk is for your discussion question. You need to discuss, okay? Because risk management is not just calculation, it will have a discussion. Every topic, in fact, in AFM has discussion question attached to it, and the marks are equally weighted. I cannot tell numbers will be more marks and theory mark questions are just 5 or 10 marks. It's not like that. Okay, it's equally balanced. So you have to work out on discussion questions as well. And since we are moving on to the new topic, that is risk management, you might face a little difficulty in the initial days because we have been doing all these days we have been focusing on investment appraisal questions, net present value, open the cash flow, discount factor, WACC, this, that. Now you need to change it and come to the risk management. Trust me, this is one of the easiest and you will love this. But this portion has lots of derivatives to deal with. But once you know, this question is the easiest. Why? Number one, because it has a standard question. I mean, you can expect a similar question only from this topic. They do not change so much this question, unlike investment appraisal, acquisition, and merger reconstruction. It can come in variety of forms, but risk management comes in one form only. They will be giving you 3 4 like derivatives, and using all those derivatives, whether currency or interest rate risk management, you convert, you hedge, and then discuss what is the best hedging position. That's what you're supposed to do. This question can come as a 50 marks question, where it will be where other things also might come, not just risk management. Okay, or this question might come as a 25 marks question. Now, based on the past paper, what I have seen, most of the time this question comes as a 25 marks question. Okay, and most of the time it is the currency risk management which comes, but interest rate risk management also has come. Okay, so let's start with the treasury. What is the role of the treasury function? Have you heard of the treasurer? You will always hear this word treasurer of a company, big company especially. Okay, why you need it? Because today the world is not like that where a single person is handling entirely everything. No, the business is very massive. There are so many shareholders. The financial environment is very complex. So in order to manage that, you need someone who is very experienced, who has the expertise of all this, and that person is known as treasurer. So it is the treasurer's responsibility to look after this. uh, they have to manage the risk. Okay, then in big companies you will even see there's a separate treasury function also, who has the skills. They need to have the skill. Treasurer is not someone who is just handling finance or just counting your money. No, he should know how to take the opportunities when it comes. He should know how to handle your risk. He should know where to invest. He should know where not to invest. Okay, and having a separate treasury function will help you to achieve economies of scale. Why? Because they have expertise, right? They have expertise. So because of that, they will drive down the cost. They can even drive down your borrowing cost also when you go for a loan. Now we are coming to the treasury and the financial control. Okay, in large entity, they might separate these two. Treasury and financial control might be done by two separate persons, but in small companies, one person can do both. Okay, now remember these things you need for your discussion question. It might come. They might tell you the duties of treasurer. That's the reason this is there. In otherwise, I would have not included in a lecture. So I know you are expecting calculations and all. We'll go for it. Okay. The next 2 lectures are entirely, trust me, entirely calculations only. They're fully calculations. Okay. Only this lecture is a little bit of not so calculation, but we have one calculation question here in this lecture towards the end. Okay, so treasurer and financial control can be split also between two people, and both of them reporting to CFO, that is Chief Financial Officer. And the second bullet point says that the prime responsibility of financial control is what? That they know how to make effective use of resources, and they have the responsibility for investment decision. And the third point says treasury function. See, financial control function is not so much important for your exam. I mean, most of the time it is the treasury's function that they will ask. So focus on that more. But you can read aside what is financial controls function also. There's no harm in that. Knowing more is always good only, not bad. Okay, so the last point says treasurer's function is to obtain finance. They should know how to obtain finance. What are the sources, from whom, at what rate? This questions will always be answered by a treasurer only because it is their responsibility. They manage the financial stakeholder of the entity, and those stakeholders include shareholders and lenders. Who manages it? The treasurer. Then we have treasurer also. There's a close liaison is often required between financial control and treasurer. Yes, they need to work together because more or less their objectives are the same, to manage risk of the company. Okay, so the first point says in investment appraisal, what does the treasurer do? They try to assess the cost of capital. Okay, they try to bring down the cost of capital by various strategies. And financial controller, they relate these factors to group strategy. Second is they manage currency risk. Okay, so when managing currency risk, what does financial controller do? They play a very important role. Why? Because they identify the currency risk, while the treasurer advises on the best mean to hedge the risk. So treasurer is like that advisor, the supervisor who is sitting at the top of the company, you can say. He knows everything. Okay, but he will not identify what is the current risk. Financial controller will be below treasurer. They will identify the risk, and then they will tell the treasurer. Treasurer is the one who is going to advise. Okay, these are the risks. Now, how to manage them the best. Which derivative should you use? Should you go for forward, future, option, swap? What? Treasurer will advise you on those. Now, in larger entities, okay, treasurers will usually be centralized at head office. That means there will be one treasurer. They will be at the head office, and it is centralized. Centralized means only one person taking the decision, and everyone below him follows. Okay, this is in a way is good also because it means you can achieve more effective control over your financial risk. You can achieve economies of scale. You can even obtain better borrowing rates, right? Now, the financial control is frequently delegated to individual units. When it is told that you have to financially control, this job is delegated to individual units. Everyone looks after it. Why? Because if everyone takes it as a responsibility, this will have a major impact on your customer and supplier. Because this individual units are the one who are facing customer and supplier on a regular basis, not the treasurer who is sitting there at the head office. You understanding? So as a result, treasury and financial control are tend to be separated by location as well as their responsibility. Even location also separated. Now, this question has come in the test. Has come in the exam in the past paper. You will see this. Often you will see this. Whether treasurer should operate as a cost center or profit center. It can operate as both. First, we'll talk about the cost center. Okay. What does cost center means? That means whatever the cost is incurred by the treasury function, this cost will be charged throughout the group on a fair basis. That is the meaning of like as a cost center if they operate. But where the fair basis cannot be agreed, then the cost remains as a central head office unallocated cost in the group. Okay. Second, we say it is cost center, okay, but treasury department can also work as a profit center by identifying revenues. You can identify revenue, how they can incur revenue. So these are the ways, okay, through which revenues could be realized in a treasury function. Number one, each division might be charged the market value of the services that is provided by the treasury. See, what are treasurer doing? They are providing a service only to the company by giving the expertise, by giving their advice on investment appraisal, by telling which risk, how to hedge their risk. What are they doing? Services only. So for that service, they can charge market value from each division, and whatever the amount they get is their revenue. But make sure when they are charging a revenue, it should be more than their cost. That's how they are going to get a profit. Then sometimes they decide not to hedge all currency and interest rate risk. Why? See, hedging is a cost. Hedging does not come without cost, okay? To hedge also you will have to incur some cost because you have to take those financial derivatives. And they're expensive. They're quite expensive. So sometimes they decide not to hedge any currency or any interest rate risk. What happens then? Rather they decide which risks to hedge, which risks not to hedge. Because some risk, if you do not hedge, is good for you. One such example is where you are going to have a favorable exchange rate. Exchange rate, you can predict exchange rate will move in your favor. So you don't have to hedge it if your prediction turns right. So you can profit from it. You can profit from the unhedged position rather. Let's say exchange rate is moving in your favor, interest rate is moving in your favor. But this is very difficult. I mean, this situation is very difficult to achieve. Then, third way, hedging using currency and interest rate options. Out of all the derivatives, options will give you that benefit. In others, you are only hedging the risk. That's it. If there is a upside, you cannot have the benefit because you are limited. But option gives you that benefit. That's why option is the most expensive. You have to pay a premium. That's how they charge. Because they are giving you an option. Either you exercise the option and hedge yourself, do not exercise the option and take the benefit of the upside when the interest rate moves in your favor or exchange rate moves in your favor. So that's also you can get a profit. Then you can take an additional exchange rate also or other risk only for the speculative reason. Why? Speculative means what you're predicting on the future. That profit will be higher or gains will be higher. So like that you can do. Now there's a trend recently, okay, that large companies are moving from cost center to profit center. Okay, why? Let's see the reasons. However, the following point should be noted, but remember there are some disadvantages also. Let's see. The first one is speculation. If you see treasurer, it's not always about hedging risk, hedging risk, hedging. They can work as in speculation also. Remember, treasurer department, they are always very knowledgeable about all those things. They're expert in speculation, hedging, managing risk, taking opportunity, everything. So they engage in speculation. Okay, if they engage in speculation, it must be properly controlled by the company's board of director. It has to be. It's not easy. Speculation is very difficult because they are not speculating in one or two penny. Millions of dollars are at stake. So they have to make sure that the risk exposure is limited. And it's monitored. All these movements are monitored, detailed. Okay. So the temptation has been for the directors to let the treasurers get on with whatever they do as long as regular profits are being earned. So what do the directors want to get? They're only concerned about profit. Now they don't care however the way treasurer do. They just want the profit. So they think let the treasurer do what they want. As long as they are getting the profit, that's enough. But this policy, remember, is no longer acceptable now. That let them do whatever they want. Now, the finance director, especially finance director, must control the treasury on day-to-day basis. They should say someone should be over treasurer to make them accountable. Otherwise, treasurer could do anything they want because they have all the expertise, which they can use it for their own advantage rather than against the company. So, in order to stop that, in order to protect the public, protect the interests of the other stakeholders, finance director comes into the picture and now they are going to control the treasurer's activity on day-to-day basis. So if they start controlling, it will be difficult for them to operate as a profit center, right? Next example, we have real life example like German oil or metal company that have managed to lose $1 billion after being overexposed to oil derivative contract. Why are they getting this loss? Because of relying on the derivative market, that is oil derivative contract. Treasurer staff. Remember the staff that you take. Whether you operate as a cost center, profit center is not a question, but the staff that you take needs to be very well trained and they have to be well paid so that the staff of the right caliber can be secured. You need the right staff in your treasury department because they have a very heavy responsibility compared to other people. And if you see the foreign currency transaction, the low volume of foreign currency transaction that is undertaken by a small company, okay, will not allow you to make a profit. You cannot operate as a profit center in a small company, the treasury department I'm talking about, because the volumes, the frequency with which they do their foreign currency transaction is very low. So with that low volume, you cannot have a profit. It's unviable. Okay, and the regular flow of a large foreign transaction is needed. You need a regular flow of large foreign transactions before the cost center approach is abundant. You are saying, okay, we are moving to profit center, but before you abandon the cost center entirely, make sure you are getting a heavy regular foreign currency transaction. The flow must come there. Now we are moving on to the international treasury function. They also face regular problems, right? Here they have a separate kind of responsibility. I mean, additional responsibility. Here, they need to set the transfer price. The treasury function will set the transfer price so that they can reduce the tax bill, right? We know what is transfer price from my earlier lecture. I think lecture 7. It is an intra-group where the parent and the subsidiaries in a different foreign currency setting prices to reduce the tax, right? Treasury department decides. Next, they decide the currency exposure policies and procedures. What derivatives are you using, for how long, what should be the amount, cost, they decide. Then transferring of cash across international borders, treasury function decides. Then what is your investment strategies for short-term funds, from what market are you taking the money, okay, all those things. Netting and matching currency obligation. What is netting and matching? We'll go through it later in the next lecture. What is netting and matching? Okay, they are kind of internal hedging techniques that we are going to discuss in the next lecture, not this lecture. Okay, so basically matching means, let's say you have a, what do you say, export, or let's say you have an import. Okay, you have to pay in a foreign currency and there's a currency risk exposure, you're exposed to that. So what do? You go and have an asset also in the same currency so that your value of an asset and the value of a liability, they cancels off each other. You are matching. That is known as matching. And netting, let's say you having a transactions with the same currency, in the same currency, okay, two different countries or two three different companies, or I would say countries are having currency in the same, so, I mean, sorry, one company only is having multiple transactions with in the same currency, so you can net off rather than trying to hedge or deal with everyone individually. Let's say you are having $3 transactions, net all the $3 transactions, the inflows and the outflows, you can deduct the outflows from the inflows if it's in the same currency. That is known as netting. We are going to go through that also in detail. Now the last question, this also comes in the exam and it came in the exam, that is, should you centralize or should you decentralize treasury activity? Centralization versus decentralization. So for that, understand what is centralized first. Centralized means, okay, each operating company holds only the minimum cash balance. See, there will be one central person who will be giving the power to everyone, but only to hold a minimum cash balance that is required for day-to-day operation. Okay, whatever the surplus they get, they have to remit it back to the center. This process, you can name it as cash pooling. All the cash are pooled. Okay. So the pool usually being held where? Where is this pool held? In a major financial center or a tax haven country. Why? Because taxes will be low. So in one country it will be there, that pool. From there everyone will extract whatever the minimum they require. That is centralized approach. Decentralized means each operating company appoints one officer who is responsible for company's own treasury operation. There will be many treasurer Everyone will have one treasury operation in their country. That is decentralized. So now we need to understand the advantages and disadvantages of centralization, because this question is often asked. Okay, centralized. Advantages of centralization. If you're having a centralized, you don't have to duplicate that treasury skill across all the group. Just have one treasurer, that's it. Just have one highly trained central department who can look after everyone else with a high skilled team. Okay, this will not be available if you are having people responsible in each company and they are looking after the treasury department, because it's difficult to hire many trained people, staff in the treasury department than having one highly trained staff. And it's a cost also. You have to give salaries. Remember, the treasury staff needs to be very well paid. So it's more costly if you're having different this thing rather than having one highly trained. So that's an advantage of centralized. Second advantage is centralized treasury department, they can borrow in bulk. And we know when you borrow something in bulk, you can reduce the cost also. Interest rate will reduce. That will drive down your cost of finance, which the decentralized will not be able to do because everyone will be borrowing small amounts each. Third advantage is the group's foreign currency can be managed better in a centralized treasury. Why? Because only they know what is the total exposure situation. Okay. And if you want to see this total picture, the total hedging position is efficiently carried in the head office compared to each company doing their own hedging, because there will be conflict of interest also. They want to take something else, that person want to take future, the other one wants to take swap. Each will be defending their own position, but if it's one person, they will do it nicely because they can see the total big picture, no? Fourth advantage, one company does not borrow at high rate while another has an idle cash. All the group are treated as single. You can sometimes extract the cash from this person to that person. Wherever they're having low cash, take from the company which is high on cash, take it and extract it. Overall rates you can reduce. Your cash will not be lying idle somewhere. It will be utilized. Then another advantage is bank charges will be lower, because you are carrying both the balances and the overdraft in the same currency. If it's the treasure centralized, it will be in the same currency, so it will be bank charges will be lower. Then a centralized treasury can run as a profit center to raise additional profits for the group. Yes. Transfer price. This can be minimized to achieve the overall group tax bill. They will reduce the overall group tax bill. And funds can be quickly returned to companies requiring cash via direct transfer. Wherever companies require the cash, quickly it can be transferred, because centralized treasury department are exposed to huge range of cash they can have. So immediately, if a company wants from the group cash, they can give it. They've exposed to it. Now we are moving on to the disadvantages of centralization. Actually, it's not disadvantages of centralization, it is disadvantages of centralization, not decentralization, because disadvantage of decentralization will be advantages of centralization only, right? So I think it's a mistake done there, but anyway, or you can take it as advantages of decentralization in that way also. That is, greater autonomy leads to greater motivation. See, everyone will have an autonomy, that means they will have a freedom of say. Okay, and you know, when a person has the freedom to take a decision, it leads to greater motivation. And it is said that individual companies can better manage cash, as also more attentively they can manage, rather than keeping the head office as responsible. So now we are moving on to the second advantage of decentralization is local operating units know the local conditions better than the head office. So they can respond quickly also to these changes. Then we are moving on to the introduction of hedging methods. We are over with centralized treasury department, centralization, decentralization, profit or cost center, their functions. Now we are moving ahead to hedging methods and make sure that we are going to deal in the next two lectures purely on these derivatives. Okay. The detail will be explained tomorrow in lecture 9 and 10. Here we are just introducing you to it. It's just the names. So the use of derivative products. First, understand what is the meaning of derivative. All these things are not important for your exam at all. I'm just explaining you the derivatives because some of you might want to understand what is derivative. For you, some of you, this might be the first paper they are giving. They might have forgotten or they might be new to this subject. So I have to take care of their concern as well. So I need to explain you what is derivative first before giving you the list because this is a very complex area in finance. It's very difficult. One of the challenging areas is derivative financial instruments. So I need to explain you what it is and how it behaves. So derivative is the performance of a derivative is dependent on the performance of an underlying asset. There's a relationship. Derivatives are, we'll see what are they. Okay, derivative is something. Just know that something and that something's value is derived on based on the value of an asset, underlying asset. That is the meaning of derivative. These are the common underlying assets for which we are using derivative, like tea, pork bellies, shares, bonds, share indices, currencies, interest rate. But we are focused on currencies and interest rates only, this two, at the moment. Now, derivatives are contracts, okay? This is the definition of derivative. They are contracts that gives the right and sometimes the obligation also to buy or sell. You can either buy or sell, both you can do. A quantity of the underlying. That means it's like a contract. Through this, you can buy or sell tea, you can buy or sell coffee, you can buy or sell currency, you can buy or sell interest rate. That is the meaning of this. And you or benefit in some other way. You can benefit also through this. For example, if there's a rise or fall in the value of that underlying, that means let's say the value of the interest rate falls down. By having the derivative, that contract you can benefit, or the currency, or the tea price, or the coffee price, anything like that. So rise or fall in the value of that underlying asset, through that you can benefit only if you have the derivative with you. It's a contract. If you do not have the derivative, you cannot benefit. That's why we use derivatives. Now do you understand? All those things, use of derivative products, not needed in the exam, no need to memorize, just understand and move on. That's it. Now these are the derivatives that we are going to study in this AFM, that is forward. And when I say forward, it is for both exchange and interest rate risk management. There are two things that we are going to hedge. One is interest rate risk, one is exchange rate risk. And for both, we are using forward. But the way we use, there are little differences. Similarities are there, differences also there. Forward is for currency, and if it is forward rate agreement, FRA, it is for interest rate risk management. From your financial management, you know there are two types of risk that we have to manage. One is a currency risk, one is interest rate risk. Both will be done separate, explained in a different lecture separately, right? First, we are going to cover the currency because that is easier. Then interest rate risk management in lecture 10. Future is for both forward and currency and interest. Then options for both, swap for both. So these are the derivatives. Again, go through it: forward, future, option, swap, forward, future, option, swap. And even in your exam, especially option, future and forward, the first three always comes. Swap, not always, but it comes especially for the interest rate risk management, and it is one of the very challenging area, but trust me, I will make it very easy for you, don't worry. And when I gave my AFM exam, I definitely got interest rate swap. I got, in fact, all the tough questions, you can see, all the tough things I got reconstructions, I got interest rate swap, I got real options, I got net present value, everything I got. And I got an option to it's a put option. So I got everything difficult, okay? And yeah, so next, out of this forward, FRA, future, they fix the future price. Their role is same. The way they work is different, calculation and all, but they fix a price for future. But only the option gives you the right. You do not have an obligation. It's not compulsory that you have to do. It's just your right. You exercise or not is up to you. Option gives you that right to fix a future price. Okay. Use of derivative products. Now, so derivatives are not fixed in volume like supply of normal equity or bond market. For example, if you are taking a loan, let's say you are taking a 10 million loan. That loan is fixed, no? The size of that loan is fixed 10 million. So you're going to get that 10 million. Derivative is not like that. Derivative does not work like that. The way they work is it depends on the existence of counterparty. You need two parties here. Counterparty you need for derivatives who are willing to take alternative views on the outcome of the same event. Let's say, for example, you are two friends, okay? One of you are predicting tomorrow it will rain, the other one is predicting tomorrow it will not rain. You are betting. It's like kind of betting on the same event only. Okay, tomorrow is the event. It's going to rain, it's not going to rain. So you bet. Obviously, one of you is going to win, the other one is going to lose. Correct? On the same event you are betting. You are taking an alternative view on the same event. That is the meaning of that. So in this case, you can take a contract, rather, derivative. You can say, okay, if it rains, this will be my loss. You limit your loss or those things, something like that. So that's an example. So such condition needs to exist for you to use derivative. Derivative stand alone will not give you any benefit. Just having that contract in your hand will not give you any benefit. Okay. Next, some derivatives like future and options, they are traded on a stock exchange. That means their contracts are standardized. Standardized means they will have a fixed contract. That means, let's say you want to hedge 1 million. So contract size is, let's say, 500,000. So that means you have to take two future contract. 500,000 one contract, the other 500,000. That's how you can hedge your 1 million. But the contracts are fixed. They are standardized. You cannot change the contract. And also their completions are granted by the exchange. There's credit risk is not there. Credit risk is zero because it is handled by the exchange rate. So you don't have to worry. And also their contracts will have values and the price is already quoted. We'll see, I will show you how. Exchange traded instruments are of standard size, ensuring they are marketable. You can always sell them. If you do not want the future, sell them to someone else. You can always do it because it is on the exchange traded. They are marketable. They have a standard size. Every company, whatever the company you are, everyone will have the standard size only. Let's say you want to hedge $1,539. But contract size is either 1 million or either 2 million. It's standard size only you will get. Out of this two, you have to take one. You will not get the exact amount of your currency that you want to hedge. You will not get that size because they're standard. They come in standard form. On the other hand, we have what is known as OTC. This comes in the exam. They sometimes tell you to compare or advantages or disadvantages of exchange traded derivative versus OTC derivative. This question can come. Okay, this you have to know. See, OTC, over the counter transactions, means it is not traded on stock exchange. Okay, how is this done? A financial intermediary, that means a bank, They might come and give you this, right? What do? They customize it for you. It's a customized. Here, let's say you want to hedge 1,039,000. You can exactly get that 1,039,000 contract for yourself through the bank. That is known as over the counter, OTC contract. But here there's a risk. What is that risk? The risk is valuation issue. How do you value the contract? Because it is not in the market, open market. A bank might come and put that bank, and they might put any value. And also the credit risk. You can default on the payment here. It's a risk. But in the exchange traded derivative, there's no risk. You can always buy and sell that contract. Here you cannot do that. If let's say the contract that you have taken from the bank, because it is customized for you, you cannot sell it to someone else. You either use it or either it's waste of money. It is wasted. Now we are moving on to the future contract. This only one contract I will be explaining you a little bit detail, but tomorrow when we do it in lecture 9, we'll be doing all the calculation. But there are some terms that you need to know when it comes to future. There are some terms. So a future contract is, it is an exchange traded contract. Okay, you can buy or sell an underlying asset, whatever the asset. In this case, underlying asset is exchange rate and interest rate for purpose of AFM. Okay, that means you are agreeing a price that you have to pay for the future today. That is the meaning of future contract. Now there are two ways of closing a position. I'm sure you know this terms opening a position, closing a position. Opening means you are opening a future position. Once you open, you need to close it also. Otherwise, how are you going to have a profit or a loss? So there are two ways of closing a position. Number one, you deliver that underlying on the maturity date. This is very rare, and trust me, in your AFM exam, this will not happen. Okay, but in reality, they are telling you can deliver the underlying. That means whatever the currency you have taken a contract to buy, you actually get that currency on that date, maturity date, or you sell that currency. This is rare. Okay, we are in the second option actually. Here, you do not actually buy or sell that currency in the future. It's just a contract. Okay? That means you are just calculating the profit or loss on the paper. You have no obligation to deliver that currency or deliver that interest rate, whatever it is. It is just on the paper. You are finding a profit or loss by closing the position. You opening a position at some price, you close the position in some price. So either you will be having a profit or a loss. That is the simple meaning of it. And you will be doing it in the future. Through calculations, you will understand it even better. But you need to know this. You don't need to write this. Discussion questions will not be asked. How do you close a position? Right? All those things will not be. What is the future? They will not ask all this thing. But you have to know it before you do the calculation. How do you hedge here? Hedging is achieved by combining a future transaction with a market transaction at the prevailing spot rate. That means you compare after you have set a price, after you have got a profit or a loss in the future, what is the position in the spot, using the spot rate, what is the position in the market? Compare the two. You can see that's how you achieve the hedging. Let's say you're having a loss in the spot rate, prices are going up. You have to buy something, prices are going up, it's a loss. But through future, you're having a profit. So your loss in the market with the profit that you're having in the future will reduce your profit. Will reduce your losses, will bring down your losses even less. I mean, your losses will be there, but it will be less. Will bring down your loss further. So that is how you're achieving hedging. I don't know how well I've made you understand this point, but definitely with calculations you can understand this. How you're bringing down that loss. Let's illustrate this. TAL is a company. It's a sugar grower, okay, who is looking to sell 3,000 tons of white sugar in August. Sugar. So this white sugar is underlying asset. They want to sell it in August. 3,000 tons, and they want to fix the price today because they don't know in the future what will be the price because of exchange. It might go up, down. So they want to fix the price today. That means no matter whatever happens to the price in the August, you are going to pay the price that you have decided today based on the contract. Okay. Suppose the quoted future price today in the exchange is $221.2 per ton, and that each contract is for 50 tons. Okay. How? Now TEL would agree to sell 60 future contract at a price of 221.2. Correct? Suppose the market price went to 230 on the final day of the contract. The future price would also equal to 230. Okay. Now, TEL has two transactions because of this. Number one, either he will sell the sugar in the open market with the price of 230. That means he's not using the future contract at all. In the open market only he's selling at 230. Second, they would buy the 60 future contract for August delivery for 230 per ton. Okay, they are going to do that at 230 only. They are going to go for the 60 future contract, but they are going to make a loss in the future. Why? Because if you see the price, it is at 221.2 something. No, it's less than 230. So using the future, through future, remember you have to sell at a less price. That is 221.2, I think, which is less than 230. So you're making a loss in the future. So if you see what is the overall net receipt, it is 221.2 only. Because through that loss of 8.8, it will bring down your price. 230 minus 8.8, 221.2 only. So this will be your next net receipt. This is how much you're going to get overall. That means this is fixed. You are not going to receive something less than 221.2. This is the meaning of hedging a position. At least minimum you are going to get is this month. Beyond this, it will not go down. Okay. Now, but this is perfect in this case. Okay. But future do not always give a perfect hedge. You need to understand why. And for this, they might ask you a discussion question why you cannot perfectly hedge. Number one, basis risk. What is this basis risk? See, basis risk means sometimes what happens is, see, because we told futures are standardized. Future, do you know the duration of future? It's for 3 months. We have March future, we have June future, we have September future, we have December future. We only have futures for 3 months. Sometimes you have to hedge, let's say, for 5 months or 2 months. Let's say 2 months you want to hedge. So for a 2 months hedging, you are going to take a 3 months future. So your duration is only 2 months, but you have taken a 3 month. That means 1 month extra you are having. It's a waste. You can only hedge for 2 months. You only need to hedge for 2 months, but you are going for a 3 month future. So that 1 month is, what is it? You have not utilized it. So it is known as basis risk. Because of that, you are going to have basis risk. We are going to show this to a calculation. Second is the size of the contract not matching the commercial transaction. Sometimes you will calculate. You need to calculate this. How many contracts do you need to hedge a position? Sometimes it's 5, sometimes it's 5.6. If it's 5, it's a perfect hedge. What if it's 5.6? Is it a perfect hedge? No. Why? Because you can never take 5.6 contract. Can you take? Think really. Can you go for a 5.6 contract? Yes, in calculation you are getting 5.6, but you either go for 5 or 6. 5.6 if you get. But you don't go for 5.6 contract. So you are either going for less or more. So because your contract is different, size of contract, that means you are not exactly hedging the entire that same amount that you want to hedge. Either you are hedging less in the future or more in the future. There is an underhedge or overhedge, but not the perfect hedge, because size of the contract is not exact. Okay. Now we have what is known as tick size. What is the meaning of tick size? You will come across this term in future often. Tick means it is the standardized minimum price of a future or an option. That means when your price moves, you say it moved by 10 tick sizes or 20 tick sizes. This is how you read future prices. That is measured by tick. How many ticks? We'll see that. Through this tick only you calculate profit or loss in the future. Okay. Let's illustrate this. For a sugar future contract, in that example, tick is 0.01 per ton. Contract is 50 tons. So you multiply the contract with the tick size and get what is the tick worth. Each contract is $0.5 tick. That means 50 ticks into 0.01 per contract. Okay. So let's say the overall movement is 8.8 per ton. Okay. See, when they tell 8.8 per ton, the movement, This is how you read it. It is known as 880 ticks. 880 ticks how? Always the tick. One tick is equals to 0.01. You need to multiply it by 100 all the time. So 8.8 multiplied by 100, that's how you get the total number of ticks. 880 ticks. 8.8 into 100 is 880 ticks. It's always like that. You need to multiply by 100. So the total loss on the contract would be this much. This is the formula. But don't worry, if you forgot the formula here, we are going to catch up on lecture 9 tomorrow. How many contracts you want to sell? 60. And contract into tick size, that means 880. You're not going to take 8.8 into per ton, no. 60 into 880 ticks into the value of the tick, that is 0.5 that you have calculated. So the total loss is 26,400. It's a loss because we know, right? We have seen in the earlier this thing. But remember, this amount will not all be collected in one go only, no. But when you close the position, what do? Instead, daily marking to market occurs. That means daily, this value keeps changing. Someday you'll be having profit, you add. Someday you'll be having loss, you deduct that from this amount. So it is known as marking to market. Every day you do this. Let's see. Next term that you are going to come across is known as, in future, margin. Margin means, see, there's a problem when you're dealing with future. Okay, especially is that having, when you want, especially when you want to make a profit. The other party to the contract, that means has to make a loss. There is no other way. If you are making profit, the other party to the future is making a loss, correct? So because he's making a loss, sometimes he might default on the payment. Sometimes he might not have the amount to pay you. So what happens? This is known as counterparty credit risk. So because of this, in order to save you, like how when you join a course in your school or colleges, they always take a deposit money, that's a safety. Later when you graduate or finish the school, you can claim it back. That's how margin works. This is like a deposit that you have to give it in the start of the future. Why? Because the buyer and the seller of this contract, they do not directly do transactions with each other. No, through someone they do it, through some members of that market. Someone comes and sets them up. So because of that, there's a risk. What if the other party does not pay me back? So initial deposit has to be made. That is known as margin of safety. Some safety has to be there in order to protect the party from this counterparty credit risk for every transaction. Okay, therefore the market's clearing house is the formal counterparty to every transaction. Every transaction, who is the counterparty? The market's clearing house. Okay, so because of them, it reduces the default risk for anyone who's dealing in future. Okay, so as the clearing house is acting as a grantor, what is he doing? He's the one who's going to guarantee for all the deals. That means he's protecting. So because he needs to protect, make sure he's making sure that there's he's operating a margin system. That means there are two. One is initial margin, one is daily variation margin. Initial margin means when first time you open a position in future, you are giving that amount. It's your initial margin. Let's say $100, $1,000. And then after that, you have to keep on adding it there if you're making a loss. Daily variation margin. Let's understand what is initial margin. Initial margin is like an initial deposit that you are giving to that account. It acts as a security against default. That is the only purpose of it. That makes your future more secure, right? Safe. The objective of initial margin is to cover any possible losses made for the first day's trading. Let's say first day only you made a loss. You never know when you're going to make a loss in the second day, third day, fourth day. You don't know. Every day you keep opening, closing position, opening, closing position. That's how future works. Every day you cannot make a profit. Every day you cannot make a loss. Let's say first day itself you make a loss. How are you going to cover up for this loss? How are you going to pay the counterpart if you are having a loss? You cannot do that. That's why initial margin is very much required in the first day only. So through that initial margin, you can cover up your loss. Now, what would be the size of the initial margin? It depends. It depends. There is no fixed size. In the question, if initial margin is the examiner will give you the figure. Don't worry. So it depends on the future market, the level of the volatility of your interest rate and the risk of default. If they are high, risk of default is high, interest rate keeps changing very rapidly, initial margin will be high. Remember that. Now, some investors use future for speculation only, but our purpose in our example, we are going to use it for hedging. But also know the other side, it's always good. They can use it for speculation also rather than hedging. So there, margin safety plays a bigger role. Okay, it's like you're betting and you might lose everything. So next we have this three: maintenance margin call and variation margin. What is maintenance margin? It's like you need to maintain that account. It should not follow below a minimum level. There should be a minimum level that you can let your account fall. Below that it cannot fall. After that you have to always keep it maintaining it. That is the meaning of maintenance margin. And at the end of each day, you will calculate your profit or loss in the future. This is known as marking to market. Okay, so that daily profit or loss, you keep adding or subtracting it from your margin account balance. Let's say your margin account balance at the start of the day is 100. You're having a profit in day 2, you're having a day 1, you're having a profit of 60. Add that 60 with 100, 160. If loss, deduct loss. But if your loss is greater than your additional profit with your initial deposit, you definitely have to do extra payment. Extra money needs to be added in that account, margin account, so that it again comes up to 100. That means it cannot fall below 100. Okay, examiner will tell you what is the initial margin, below what it cannot fall down, and all those things. And this question has a calculation question also to it. We'll see it in the next lecture, not this lecture probably. If this causes the account in the margin account to fall below the specified maintenance margin, you see below the maintenance margin, account cannot fall. Let's say your initial margin is $100, your maintenance margin, let's say 75. That means below 75 it cannot fall. So the moment it falls below 75, again you will top it and bring it up to 75. Understand? So that is known as margin call. That extra payment that you're doing is known as margin call. So that it comes up again to that amount. Okay, you make a margin call to the investor. That means you're telling investor that deposit that you are doing extra fund is known as variation margin. Okay, and what if you are unable to do that? If you are unable to do that variation margin, pay that variation margin, you are going to default, and then contract is closed. So when the contract is closed in this way, thus protecting the clearinghouse from the possibility that the investor might accumulate further losses. It protects you in a way. Rather than accumulating losses on losses and losses, contract is only closed. So without providing cash to cover them, if you're accumulating too much of losses, you have to provide the cash to cover them. So because the future will be closed, you do not need to do that. So you are protected. The clearinghouse is protected. Now let's do a small question before we move on to the types of forex risk. The three types of forex risk. So this is a numerical example of future. Peter NG is a wealthy speculator who believes that oil prices will fall over next 3 months. Oil futures are quoted with the following details. Future price for 3-month delivery, 68.2 per barrel. Contract size is given. Tick size is given, 1 cent per barrel. Initial margin 10% of the contract. Peter decides to set his level of speculation at 10 contracts. Now you have to calculate initial margin. See, even in your actual exam, you have to do those things. You should know how to calculate. And B, assuming that initial margin calculated in part A is the same as the maintenance margin, calculate the required variation margin the next day if the future price moves to this one. You should be able to know, especially part B. This has been asked. So now let us do part A. Calculate the initial margin. How are you going to do that? They told us 10% of the contract. So 10% of how many contracts? Speculation is at 10 contracts. Right? 10% multiplied by 10 contracts into, you have to multiply the contract with the number of the barrel. How many contract size? 1000. And then the price. What is the price? 68.2, the future price. 68 68.2 per barrel. Nothing with tick size and all. Tick size and all you multiply when you're finding the profit, not in the initial margin stage. Okay. So now, what is the price? 68,200. This is your initial margin. Okay. And you need it in part B. Assuming the initial margin calculated in part A. Okay. This is $68,200. Okay. And price went to 68.35. The price is 68.2, price went up. Wait, 3 months for delivery. Okay. So the price went up, it's a profit or a loss? He will make a loss or a profit in the future. Understand this, please. Price increased means he will make a loss. What is the loss? Difference of the two price. 68.2 is the future price minus 68.35. If you see the difference between the two, it is 0.15. And this is a loss in the future. He's making a loss, price increased. 0.15 per barrel. Per barrel. This is how you write it, per barrel. So 0.15 per barrel means in terms of ticks, how many ticks? I told you, always multiply it. The loss, 0.15 into 100. Always into 100. So it is 15 ticks. That means 15, loss is 15 ticks. This is how you read it in future. Loss 15 ticks. And you want to find the total loss. Just knowing 15 ticks is not enough. You need to know the total loss. Always you have to find the total loss. How do you find the total loss? Multiply the number of the contract with the ticks. How many contracts? 10. What is the loss? 15. And what is the per tick value? 15 ticks are there, but per tick, one tick is how much? You need to multiply it by 15. Here the tick size, basically. This is the meaning of tick size. You have to take this tick size into the picture. 1 cent per barrel. 1 cent means it will be 0.01. Or if you wanted to read it, okay, sorry. 1 cent, 1 cent. I think it is, yeah. And what is the barrel? Per barrel, it is 0.01. So if you multiply this by 1000, how much it will be? 10. So it is 10 per tick. 10 per tick. You just write it per tick. Already you have multiplied it with 15. 15 ticks. Okay. 0.01 per barrel. There are 1000 barrels. That's why you need to multiply the 1 cent. That is 0.01 by 1000. That's how you are getting 10. Okay. That is the tick size that you are getting. So the total loss is 1500. This is the total loss. And if you see your initial initial margin is 68,200. So from the 68,200, this 1,500 will be deducted. That means it will fall below 68,200. But they told your maintenance margin is also same as 68,200. So again you need to pay 1,500 so that it becomes 68,200. Okay. Now let us go to the three types of forex risk. Types of forex risk. There are three types of forex risk. The first one is known as transaction risk. It means those risk. Okay, that means you are doing transactions internationally. Okay, you might be exporting, you might be importing, anything it is. You are going to face this risk. Okay, so this risk happens when your exchange rate changes from the transaction date till the settlement date. You might have a gain, you might have a loss, depending on the exchange rate, whether it is going in your favor or against you. Okay, and this is associated with imports and exports. You should do some type of transactions internationally for this risk to happen, otherwise it will not happen. If you are not having any exports and imports, you are not going to have this transaction risk at all. Okay, and this type of risk is the risk that we are going to hedge in the next two lecture. Okay, This type of risk you can hedge using variety of financial products, future, options, swap, all those things. Now we are moving on to the second type of risk, that is economic risk. This is long term in nature. Okay, it will have a longer term effect, like the market value of the company is changed because of the exchange rate, which can affect your present value of future cash flow. This looks at how changes in exchange rates affects competitiveness. Maybe the country's competitiveness reduced directly or indirectly. It could happen in any way. This you can reduce by geographic diversification. Let's say you are exposed to one currency risk. Go and invest in other countries, so at least the exchange rate that is strong, there you can get the benefit. And ultimately, overall, your exchange rate is reduced. You understanding? But the impact is long term, so this is hard to hedge using your derivatives. This type of risk is hard to hedge. Usually, it is not hedged also, it is left like that. And the third is translation risk. This risk happens when you translate your assets or liabilities, the foreign subsidiaries assets or liabilities, to your local currency. Okay, you can hedge this type of risk by borrowing in local currency to fund an investment. Here also you are going to have a gain or a loss, but remember, this gain or loss is unrealized. It is already on the paper that you are going to have this gain or loss due to translation. So firms do not hedge this usually. Okay, now let us summarize everything that we have discussed in this lecture. We started with treasury. We started with the role of treasury function, and we told how it is different from financial control. They give advice for hedging, they are in the speculation, they advise on the investment appraisal, where to invest, working capital, they all these things. And financial control is working on identifying the risk. They could be set in different location. Treasury could be cost center or profit center, right? We have seen how they can have the profit, the various methods. Then we moved on to centralization versus decentralization, why it is good to be centralized versus decentralized, or why it is good to be decentralized. You have to know both the advantages and disadvantages. Centralized means where there's a head. Okay, treasury department is in the head office, they are taking all the decisions. Decentralized means all the people are there and they're taking their decision. All the treasury functions are done in each organization. Then we moved on to the hedging methods, use of derivative products. We have talked about future, option, forward, FRA. But in future we have went to detail, and these were the terms we came across: initial margin, mark to market, because we are going to have daily profit loss; maintenance margin, that means below this your balance cannot fall down; margin call, where your account is below the maintenance margin. You make a margin call to the investor; and variation margin. That extra payment is known as variation margin; and tick size, through which you calculate a profit or a loss in the future. Then we ended with types of forex risk. The three types of risk: transaction, translation, and economic risk. Transaction and translation you can hedge up to somewhat. Economic risk usually you can't. But through geographic diversification and all you might, right? But mainly the type of risk that we are going to focus in the next two lectures are example of transaction risk. That means you are doing some type of transaction, exporting or importing from that foreign country. Okay. Translation and economic risk we are not going to talk about more detail. This is all day it. You just have to know the discussion part. That's it. So that's it for this lecture. Thank you for watching, and don't forget to do a question on treasury chapter. There are questions in the past paper. Please go out and check. I've done the revision kit. Entire revision kit solutions is there on my playlist, AFM revision kit solution. Please go and check it. And if you have not subscribed to my channel, or if you know such people who you think deserve to watch this, please let your friends know, share to them. As you know, exams are coming near. Okay, and this is one of the challenging paper. AFM, trust me, is one of the toughest paper, and that's why many people come to me, and I don't want you to get this video at the last moment, the day before your exam or after your exam. So please, please, please do me a big favor and do forward this to your friends, share it with your friends, share the link of my channel. I'm going to upload AFM lecture for the September exam, and by the end of August I'm planning to finish all the lecture. So every week I'll be doing one section. I've finished with investment appraisal lately. This week I'll be finishing the risk management, and before I move on to acquisition and merger. So hope to see you in the next lecture with lots of calculation. Please have good food, sleep well, look after yourself. And because my next two lecture is going to be pretty lengthy. Both are going to be, I think it's going to exit 4 hours. I think they're going to be long because lots of calculations will be there, lots of derivatives are there. So please make sure that you build up the stamina to watch it. And I always suggest it's always good to watch in one go if you can. I mean, you will have that flow. But anyway, you can always watch my video. You can pause, watch later. It's not compulsory you have to watch it in one go. You can watch it in your own sweet time. But with watching my video, doing questions, doing past papers is compulsory. You cannot let it go. You cannot sacrifice on those things. Just watching my video will not help you pass AFM. Trust me on this when I'm saying it. Do the questions on Excel, write it on Word, do it on a CV platform, don't do it on paper because everything is now on a computer, right? Best of luck and see you in the next lecture.